Partnered by Times Influence.
Hello and welcome to another episode at the 4th edition of Birla Sun Life Mutual Fund presents Voyage Navigate 2017, powered by ET Now. Historically, equities are supposed to give the best returns across asset classes in the long term. So what goes into equity research and fund management, and what is the outlook for the Indian equity market? Let's find out. I'd now like to invite up on stage someone who has over 23 years of rich experience in fund and investment management. Please welcome the Chief Investment Officer, Equity Investments at Birla Sun Life AMC, Mahesh Patil, as he shares an outlook for the Indian equity market.
It gives me immense pleasure to again reconnect with you and express our view on the markets like we have been doing in the last 4 years. I think it's important to understand that trying to predict the markets, I think, is something which is very, very, very difficult. And this has also been helped because, to some extent, by stimulus, which China came in and gave a fiscal stimulus that helped the global economy to reflate back. As we stand at this point in time, we see that the return on equities going forward are driven by the 8 Rs. These 8 Rs are reflation, Republicans, remonetization, the reform process, the rupee stability, rate cuts, and return of earnings. But while the global growth is improving and the headline inflation is moving up in US and in Europe, the core inflation is really at a pretty benign level. It's more or less flattish. It's not been impacted. And this is a kind of a Goldilocks scenario what we have at this point in time, where growth is improving, but inflation is benign. And this is good for risk assets. So the risk on, I think, if this situation continues, will going going forward, and it will favor the riskier asset class. The 4 R which will drive the markets is the reforms. I mean, after the Modi government came to power, they'll be completing 3 years now. We have seen a slew of reforms, big reforms. I think we haven't seen that in a long, long time. I mean, we all know about the Jam Trinity, about Jan Dhan, Aadhaar, and mobile. Okay, what it has done for financial inclusion. The direct benefit transfer, again, is a big reform where we are seeing subsidy being directed directly and trying to weed away all the inefficiencies in the system. I think this will have a permanent impact in terms of bringing down the overall subsidy burden for the government and improving the fiscal side. And GST, again, a landmark reform which the government has taken, which was in the works for the last 20 years. And then various bills like the bankruptcy bill, the real estate regulatory bill. I think all these reforms, what we are seeing, we haven't seen the full impact of that. The full impact of that will be seen as the execution happens on those. So I think we don't require any more reforms. Most of it are in place. There are a couple of issues like the banking sector where we need to address the NPA issue, or the job creation, because that's going to be a big challenge for the government. How do they really improve that? These are probably 2 areas where we see the government needs to work on the reform side. The 7th R is the rate transmission, I think, which was something elusive. We have seen 170 basis point rate cut by the RBI governor, but rate cuts, transmission not happening. But after the demonetization, we have seen the SBI cutting the MCLR rate significantly, and almost all of the rate cuts have been now transmitted. So there has been almost 200 basis point kind of a reduction in the borrowing costs for the corporate India. And bulk of the benefit will come in this next fiscal year. For every 1% decrease in interest rates, the Sensex earnings can go up by around 3% or so. And finally, it's the return of earnings, because that's the most important for equities to do well. I mean, in the last 3 years, we have seen the equities returns, I mean, the corporate earnings have been more or less flat. This has been the longest streak what I've seen where earnings have remained flat. And we think that it's time for the earnings to return back in FY18. It should have happened in FY17 itself, but because of demonetization in the last couple of quarters, we have seen a setback to that. We think the earnings are set to reflate back again next year. Again, the factors for that are recovery in the global growth. The focus of the government on infrastructure, housing, and rural will help the domestic economy to come back. The rural economy come back because of the good monsoon, the rate cuts. All these factors will help the earnings growth to bounce back in a big way. Some of the sectors where we see will have very strong growth is autos. I mean, this is nifty earnings growth, primarily because of volume pickup, both in 4-wheelers and 2-wheelers. Engineering infra, okay, we have seen some pickup again there, especially in power T&D and the road sector. Media, metals, metal prices have rebounded pretty much, but a lot of Indian companies are seeing a deleveraging which will help them to increase their earnings. And financials. This is not only the private sector banks, but this year also will see the corporate banks, because the low base of last year should see earnings come back. Even pharma and cement will show pretty decent growth. The third C, which we talk about, consistency. I think the proof is there in eating the pudding. So in terms of beating the benchmark, we have almost 100% of our funds beating the benchmark across various time frames, 1 year, 3 year, or 10-year time frames. But more importantly, it's how we do against our peers. And as I said, our focus is to maintain consistency. We target to keep our fund always in the top 2 quartiles. And we have almost 93% of our funds in the top 2 quartiles, which is, again, something which we aspire to do and maintain that consistency going forward. Before I end this, just remain disciplined. And I'm reminded of the quote by the famous investor, Howard Marks, who says that it's not the things that you buy and sell every day that makes you money. Okay, it is the things that you hold makes the money. And that's the discipline if you follow in investing. And I'm sure your journey in investing would be pretty smooth and rewarding. Thank you.
Moving on, now our next speaker is someone who has his finger on the pulse of global equity markets. He's a well-known and respected market expert and has over 30 years of equity research experience across various sectors and markets, including Australia, Asia, US domestic, and EEMEA. Please welcome the head of Asian strategy as well as the global coordinator of equity strategy at Macquarie Securities, Victor Schwetz.
The world of abundance and zero marginal cost. What does it all mean? Well, it means that it's a completely different world. Economics is a science of pricing under condition of scarcity. If you don't have scarcity, what happens to economics? Our global view and our global message remain pretty much unchanged for at least the last 6 or 7 years. You might argue we're lazy, but there was really no need to change that. We've basically been arguing on a global basis there will be never again a return to conventional business and capital market cycles. The global economy is likely to be stuck in a low equilibrium, and low equilibrium is really like a fever. It sort of doesn't kill you, but gradually, day by day, destroys your organs as you go forward. And that's what we are likely to experience over the next 5, 10, 15 years. The macro environment will continue to be characterized by very aggressive public sector. Increasingly, private sector will not be making decisions that you assume private sector actually makes. Now, we reach the stage where drowning in capital. The biggest business we have right now is capital manufacturing other capital. We don't actually manufacture anything. We're just cloning ourselves. So if you step back from the debt levels and say, okay, how many financial instruments do we have outstanding on a global basis? Well, depending how you count derivatives, it could be between $500 trillion to $1,000 trillion globally. Is repo market a form of capital? Of course it is. Is Eurobond market a form of capital? Yes, it is. Is bond market capital? Is equity market capital? All of that is capital, various forms and shades and sizes. We kept multiplying it, we kept creating, and there was never any decline, even through 2008, 2009. We never stopped creating more capital. As we create more capital, inevitably, marginal return on capital declines. And so we're drowning in capital. Capital has no idea where to go. It's trying to find a way. Now, one of the ways to go is to come to the ground and do something useful, but that's not what's happening. The capital just stays in the confines of financial industry. So there is a significant shift going on. It acts against emerging markets, at least against a type of emerging market business model that evolved around 1 to N. In other words, scaling, integrating in the global economy, lower costs, arbitraging the costs between the countries, it's going very, very rapidly. Now, how do we invest? Well, what we're basically saying is that investors are now living globally, and some markets are different, of course, but globally, in a market dominated by passive investments, by ETFs, by artificial intelligence? Well, to my mind, there are 4 alternative investment strategies. One, be a fast follower. Whatever the trend is, just go with it. Machines do it much better than humans, though, and therefore you really are not going to fight this game. If you want to be a Citadel, if you want to be a Renaissance Technology or JP Morgan, you can do it. They've got their own race to singularity. Eventually, they'll be splitting atoms. But that's not the game for most our clients. What's your second alternative? Well, the second alternative from my perspective is to say if politics, that's the only thing that matters, if public sector, the only thing that matters, why do you bother with conventional economics or private sector? You should only be a political economist. So what's your other alternative? Well, go passive. There's nothing wrong with that. When I look at some of our clients, they run portfolios of 100, 200 stocks. That's effectively passive. They're just running ETF and just claiming high fees on the back of it. And there is nothing wrong with accumulating money so long as you recognize you don't actually manage it. From a macro perspective, I generally try to tell people don't make macro calls, please. And the reason is very simple. If the public sector is determining everything, you don't have informational value in the signals you're using. So if the private sector steepens the yield curve, we know what it means. If it flattens, we know what it means. If the spreads increase, we know what it means. If public sector does it, what the hell does it mean? Even public sector itself doesn't know what it means. In other words, public sector is now recognizing that financial cloud, which is 10, 15 times larger sometimes than the underlying economies, are far more important than the real economy. We like India. We have been overweight since November. We continue to be overweight. The other country that benefits will be Philippines, in my view. China only wins if it reflates or if everything collapses. The other thing I like about India, India has the best of corporates and the worst of corporates. In a sense, it's like the best of the best and the worst of the worst. And so whether you run an anti-quality portfolio that we do, it's populated by a lot of Indian names, or whether you run a quality portfolio, it's also populated by a lot of Indian names. So you actually do have a plethora of things you can choose from if you actually want to be there. Well, thank you very much for your attention. Hopefully it was useful.
Moving on, it's now time to steer the talks towards equity markets. We have a star-studded panel lined up to talk about the works behind the work, an insight into equity research process and fund management. And to moderate the panel, I'd like to invite up on stage ET Now's senior news editor and anchor, Tanveer Gill.
You know, across funds over the last 10 years, and this is a number that really surprised me, all of Birla Sun Life mutual funds, key performing funds, generated an alpha of between 3 to 6%. And this is across categories over the last 10 years. What was the magic mantra? How did you manage such a consistent performance?
Let's understand what are the key drivers, why year after year we've been able to really give strong alpha generation capabilities. What are the key differentiators? First and foremost, we believe in the process. Our 3 pillars of investment strategy is the 3 Ps that we talked about. And we really believe in that, believe in the process of investing, process of identifying stock, creating an investment universe, and ensuring that we have a clear, defined template for each fund, so that it meets the objective of the investment, philosophy of the investment strategy that is placed in the fund, and is maximized to the best extent. The second key differentiator is the way the team interacts, the interaction between the fund managers and the analysts. We have a pretty large team, and when you're dealing with such large team, the way collectively the team works to ensure that the collective knowledge of the team gets embedded in the fund is very important. And last and not the least, I think in the short run, there is really no differentiation or really no alpha left. So the idea of the investment team is to make everybody think long term, think differentiated, think about the obvious, And it is that process which is encouraged within the team.
Vineet, within that thought process, you took a bet on metals at a time when metal prices were plummeting. Was that a contrarian call, or did you believe that, in a falling market, some of the well-placed metal companies would still perform?
It does look like a contrarian call in hindsight, when the sky was falling apart, you buy these shares. But what exactly happened at that point in time was we were coming in, we had seen a period where we'd seen a lot of pressure on commodity as a space, oil prices falling, metal prices falling. Globally, a lot of companies are defaulted on their bond commitments, etc.
Milind, a big overpaid position in oil and gas also helped the fund house last year. What gave you the conviction to, increase your position out there? And also, oil and marketing companies, do you think that the scope of re-rating still exists for that sector?
Yeah, so in this sector, I think we have been overweight since last 3 years almost. And since last 3 years, we have been gaining almost 40-50% CAGR. So even going forward now, what would happen? I mean, what would happen from now? We are going from something like I was buying petrol whose price was changing in 15 days. Now every day the price would be changing. I don't know if it is 75 rupees or 76 rupees or 77 rupees. That's the classic case where individual companies are focused on making money. Money not at the cost of people, but then at the cost of the future capex which they need to do. And that is probably the time when we are going to see another next move of, say, whatever, I can't put it in numbers, but you can see another big returns in next 2 to 3 years in this sector.
In oil marketing companies?
Yeah, a lot in this oil marketing companies.
Okay. Dhaval, banking and financial services. You pick any stock that is suffixed with a bank, it's done well in the market, unless, of course, there was some real big problem on the balance sheet. NBFCs have done really well. My question to you is, do you really have a problem in selecting what to buy, or is there a problem on where to book profits from? Because everything is so great in terms of generating returns. It's been one rewarding sector across the board. So I don't know how much of a challenge do you face in buying the stock. I think the greater challenge is when to exit for you.
We look at buying businesses and keep hold on that businesses. So there is no point of coming to selling or things like that. Means we've been big investors in structural companies within the financial services space. So I keep mentioning financial services. It's not just banks. There are significant number of elements within the BFSI space. NBFCs is one big pack, which used to be not seen as so big 3 years back. Which we saw as a big opportunity.
Absolutely, and I'm told that the Banking and Financial Services Fund, which was started in 2013, has more than doubled investors' money. So
we've given, currently we've given close to 30% CAGR for the last 3.5 years.
Satya, I have a question for you. Being a multi-cap fund manager, where you have 60% exposure to large caps, 40% to mid caps and small caps, how do you maintain the balance? How do you keep to your ratios and the limits of investment? Because there is a little bit of a play between greed and fear when it comes to the small cap universe, which has outperformed the large cap space. But there's an element of heightened volatility there as well.
The ratio of large caps and small and mid caps is defined by the character of the fund, which is a multi-cap fund. So we want to maintain the character as a multi-cap fund. So we have we maintain a minimum exposure of 60% to large cap and 40% to small and mid cap. So that's the maximum exposure that we can have in. So, but we don't consciously decide on what percentage it should be. So it is primarily driven by the bottom-up research that the analyst team does and the ideas that we generate. And typically, the percentage of small cap is quite low in my fund. It's more of large cap. The main area where I focus on is the smaller large caps and the larger mid caps. I think that is where it is a safe zone compared to pure small caps.
I also want to talk, Vineet, about the opportunity that you see in commodities going forward from here. So you've played the rally. You've taken advantage of the upside. But how much more to go? I personally felt that the rally last year was really about a catch-up because these stocks were so oversold by the end of 2015 that there was a strong bounce back, and so you outperformed in 2016. Into 2017, the build-up was seen more as a structural change in the sector. So is this a second wave that continues because the stocks will go higher from here? And of course, what's happening in China is with them curbing their capacities would be beneficial for Indian companies.
Sure. So, I mean, you've got it absolutely right. So last year it was, the prices and the valuations were bombed out, right? And there was a pullback from then on. It's been much faster, much swifter than we thought it would be. But now the story is actually evolving, right? As it typically happens with these kind of sectors. So the ultra cheap valuations are behind us. Now what has happened is most of these companies are through with their capex plans. They are actually throwing a lot of free cash flow, and they're using this free cash flow to reduce their debt. So our view is that even if commodity prices stay where they are, they don't really need to go up. These companies are throwing so much of cash and reaping their debt. There's still significant upside left in most of these names.
Finally, Jayesh, there's always the argument about stretch valuations with mid caps and small caps.
I know that was coming.
Yeah, so I thought that was a good question to end the discussion with. What's your word of advice to essentially investors out there on how you strike the right balance to ensure that you don't get carried away by greed?
Mid and small cap are a high beta portfolios which will do exceedingly well during periods of bull market, and we very clearly see and believe that we are in a bull market which could probably last for next few years or many more, and all the key ingredients of bull equity markets are in place. So clearly from a 3 to 5 year view, equity market view is positive, and so is the positive view on mid and small caps. Having said that, would there not be corrections? Of course, there will be multiple corrections, as we have seen in the past as well. Every bull market has a fair amount of corrections, and this bull market will also have one. In the last 2 years or so, mid and small caps have significantly outperformed the large cap, and maybe some of that has got to do with the catch-up that this segment is having, because you had a very poor 2012 and 13 in mid and small caps. So the valuations are catching up. One of the key questions that I get is, are the valuations higher than large cap? The answer to that, to our mind, is actually resounding no. What has happened is, in 2012 and 13, mid caps and small caps are quoting at a substantial discount. That discount has narrowed. And the way we look at the whole segment is, for every sector and subsector, we look at the large cap, top mid cap, and top small cap, and look at the valuations of each in the segment. And because of the large analyst team, we track over 400, 500 stocks. And in every segment, what we find is that mid and small cap valuations are converging, but mid caps are not higher, or small caps are not overly high valued. In fact, the situation is the reverse. Because of the economic slowdown earlier that we saw, and the slow growth in the economy and the earnings, there are far number of new businesses in the mid and small cap space which are doing exceedingly well. So this segment will continue to remain very exciting. It will continue to generate outsized returns. Obviously, the beta of this segment is high, so in correction it will fall more. Investors should always be very careful about which type of investors or which type of investors should be investing. Only those who know and understand the segment can take the volatility, should write this, as they will also get the benefit of this.
Yeah, over the long term, equities always reward investors with the power of compounding. Thank you very much, gentlemen, for joining me on stage for this equity panel discussion. Thanks very much for being a lovely audience. Thank you very much.
Thank you.
Some more investment insights from the 4th edition of the Birla Sun Life Mutual Fund presents Voyage Navigate 2017, powered by ET Now. Next week, we're bringing down the curtains on the series with a focus on fixed income investments. Until next time, from the entire team, many thanks for watching.
Partnered by Times Influence.